September 15, 2008. 6 a.m. in the morning. Employees of Lehman Brothers, one of the most powerful banks on earth, showed up to work carrying cardboard boxes. Not to move in, to move out. Overnight, their company had filed for the largest bankruptcy in American history, $639 billion. Gone. The people who worked there found out from the news. Not from their bosses, from the news. That morning changed the world, and almost nobody saw it coming. Almost. Before we go any further, do you know where your money actually goes when you put it in a bank? Most people don't. And that ignorance, that gap in understanding, is exactly what Wall Street counted on. Act 1, the setup, how it all started. Let's go back to the early 2000s. After the dot-com crash of 2001, the U.S. Federal Reserve dropped interest rates dramatically to push the economy forward. Cheap money flooded the market. Banks had cash, lots of it, and they needed somewhere to put it. That somewhere was housing. Banks started giving out home loans mortgages at a pace nobody had ever seen before. And not just to people with good credit and stable jobs. To anyone. Literally anyone. These loans had a name inside the industry: ninja loans. No income, no job, no assets. That was a real term, used by real bankers, inside real institutions. A strawberry picker in California earning $14,000 a year was approved for a $720,000 home loan. That is not an exaggeration. That case was documented and presented to the U.S. Congress during the 2008 hearings. The banks approved it anyway. Why? Because they had a plan, and it had nothing to do with being paid back. If a bank gives you a loan, they know you can't repay. Who benefits from that? Act 2, the machine, mortgage-backed securities. Wall Street had built a machine. Here is how it worked. Step 1. Local banks gave out mortgages to people across America. Risky ones, unstable ones, loans that looked fine on paper but were built on sand. Step 2, those mortgages were bundled together by the thousands and sold to Wall Street firms. Companies like Goldman Sachs, Bear Stearns, Lehman Brothers, and Merrill Lynch. Step 3, those firms repackaged those bundles and sold them to investors around the world as what they called mortgage-backed securities. They marketed these as safe, profitable investments. The investors buying them: pension funds, retirement accounts, city governments, foreign banks, teachers' unions, police department savings, ordinary people's money just stored somewhere else. Step 4, and this is the part that matters, the rating agencies gave these products their highest possible rating. A, AAA, the safest investment classification that exists. Moody's gave it. Standard & Poor's given it. Fitch gave it. All three of them knew the loans inside were deeply unstable. They rated them AA anyway. Why? Because the banks paid them to. That's not speculation. That's what came out during the U.S. Senate Permanent Subcommittee on Investigations in 2010. Under oath, the rating agencies were being paid by the same firms whose products they were supposed to independently evaluate. That is a conflict of interest so obvious, so brazen, that it should have been illegal. It mostly wasn't. EXE 3 CDOs, the fraud inside the fraud. If that wasn't enough, Wall Street went further. They invented something called CDOs, collateralized debt obligations. They took the already risky mortgage bundles and made new investment products out of them. Packages of packages, risk stacked on risk, wrapped in legal language nobody outside Wall Street could decode. Some firms were doing something even worse. They were selling these products to their own clients while privately betting those products would fail. In April 2010, the U.S. Securities and Exchange Commission charged Goldman Sachs with fraud. The accusation was that Goldman created a mortgage product called Abacus 2007 AC1 specifically designed to fail, while simultaneously selling it to investors as a sound investment and allowing a hedge fund manager named John Paulson to bet against it. Goldman Sachs settled for $550 million. No criminal charges. Internal Goldman Sachs emails, made public during Senate hearings, showed their own employees describing their products in language that is impossible to misread. One email from a Goldman executive used the word shitty, his word, to describe a deal they were actively selling to clients. They knew. They sold it anyway. If you sold someone something you privately knew was broken, what would we call that? Act 4, the lifestyle, what they were doing while it burned. While all of this was happening while the bomb was being built, the men at the top were living in a way that is almost impossible to comprehend. Dick Fuld, the CEO of Lehman Brothers, received over $500 million in total compensation between 2000 and 2007. That is confirmed by congressional records. When he was called before Congress after the collapse, he was asked directly, "Do you feel any responsibility?" He said he felt horrible. He kept the money. John Thane, the CEO of Merrill Lynch, approved a $1.2 million renovation of his office suite during the period Merrill Lynch was losing billions. That renovation included a $35,000 commode, a decorating item on the company's account. Merrill Lynch received a government bailout shortly after. Thane was eventually asked to resign. He was not prosecuted. In 2007, 1 year before the complete collapse, Wall Street firms paid out $33 billion in bonuses to their employees. $33 billion. To the people building the machine that was about to destroy the global economy. After the crash, after the U.S. government used $700 billion of taxpayer money to bail out these institutions under the TARP program, those same bailed-out banks paid $18 billion in bonuses in 2009. With your money. To themselves. Act 5. The collapse. What actually happened. By late 2006, housing prices began to fall. By 2007, people, particularly those with the most unstable loans, began defaulting. They couldn't make payments. The whole machine required them to keep paying. When they stopped, the bundles became worthless. The securities became worthless. The CDOs became worthless. March 2008, Bear Stearns collapsed. A company with over 14,000 employees and a history going back to 1923, sold off in an emergency deal arranged by the Federal Reserve for $2 per share. A year earlier, the stock was trading at $170. September 7, 2008. The U.S. government took over Freddie Mac and Fannie Mae, the two largest mortgage companies in the country. Combined, they backed more than $5 trillion in home loans. September 15, 2008, Lehman Brothers filed for bankruptcy. $639 billion in assets, the largest corporate bankruptcy in American history. 26,000 employees lost their jobs in a single day. That same week, AIG, the world's largest insurance company, nearly collapsed because it had sold hundreds of billions of dollars in insurance on those same toxic mortgage products. The U.S. government bailed it out with $182 billion. The stock market dropped nearly 778 points in a single day, the largest single-day point drop in history at that time. Ben Bernanke, the chairman of the Federal Reserve, later said, and these are his words, that out of the 13 most important financial institutions in the United States, 12 were on the verge of failure within a period of a week or two. 12 out of 13. The entire system was hours away from shutting down. The system almost completely collapsed. Not because of a war, not because of a natural disaster, because of decisions made in boardrooms, approved by regulators, blessed by rating agencies, and hidden from the people whose money was being used. So who was watching? Who was supposed to stop this? Asset 6, the real cost, not numbers. People. Between 2008 and 2010, 8.7 million Americans lost their jobs. 10 million families lost their homes to foreclosure. Household wealth in the United States dropped by $13 trillion. That is not the government's money. That is the money people had saved. The value of their homes, their retirement accounts, their investments, gone. The unemployment rate hit 10% in October 2009. The crisis didn't stay inside America's borders. It spread. Iceland's banking system collapsed entirely. The country went bankrupt. Ireland required an international bailout. Greece entered a financial crisis that lasted over a decade. Entire economies across Europe contracted. The International Monetary Fund estimated the global cost of the 2008 financial crisis at $22 trillion. $22 trillion. ACT 7 justice, the final insult. After the biggest financial fraud in modern history. After $22 trillion lost globally. After 10 million families lost their homes. After 8.7 million jobs disappeared. One person went to prison from Wall Street. One. His name was Karim Sarageldin, a mid-level trader at Credit Suisse. Not a CEO. Not a board member. Not one of the architects. One mid-level employee. The Justice Department under President Obama was criticized extensively by members of both parties, by legal scholars, by journalists for failing to prosecute the senior executives whose decisions caused the crisis. In 2014, the Department of Justice reached a $16.65 billion settlement with Bank of America, the largest corporate settlement in U.S. history at the time. No criminal charges for individuals. Goldman Sachs settled for $5 billion in 2016. No individual criminal charges. JP Morgan settled for $13 billion. No individual criminal charges. Settlements, fines, paid by shareholders. The executives kept their bonuses. There is a principle in American law that corporations can be held accountable. There is a principle that individuals within those corporations can be held personally responsible for criminal acts. Neither principle was meaningfully applied after 2008. So here is the question, and I want you to actually think about it. When a system fails millions of people, destroys trillions in wealth, and the people who designed that failure face no personal consequence, is that a system that failed? Or is that a system that worked exactly as it was designed to? The 2008 financial crisis was not an accident. The warnings were there. They were ignored. Investigators who raised alarms were sidelined. Whistleblowers were silenced. Regulators who asked too many questions found their budgets cut. And when it collapsed, the people who lost everything were called irresponsible borrowers. The people who built the bomb were called too big to fail. That's not an oversight. That's a choice. And the same institutions, J.P. Morgan, Goldman Sachs, Citigroup, and Bank of America, are larger today than they were in 2008. Nothing structurally changed, which means the only real question isn't what happened in 2008. The question is what happens next time, and who exactly is going to pay for it.